I think many of us are really starting to understand that we're pretty fucked. Our future's been taken from us. It's been taken from us because of the amount of debt in the system, the action of central banks debasing currency, the problems of demographics and aging populations. It's a huge problem we all face, whether it's the retirement crisis later in life, or whether it's trying to just afford to get on the ladder earlier in your career. Or many of you who are having kids, you're thinking, how the hell am I going to afford all of this?
Over the previous year, Real Vision CEO and co-founder Raoul Pal gave investors one crucial suggestion for preparing for the fourth industrial revolution, or exponential era. The macro guru realized the new age's importance after observing these items. For instance, central banks printed more money than projected. Asset values inflated due to Fed and other central bank overprinting. At least 10 technologies, including e-commerce delivery robots, self-driving cars, video conferencing, and telemedicine, were adopted faster due to the pandemic. My friend also noticed that the Fed balance sheet shows that none of these technologies are in a bubble, just that the currency has lost so much value. Based on his observations, technology prices will skyrocket in the coming decade. He recommends investing in the changeover before prices rise. A buddy thinks the world's biggest economies reset their economies in 2008 after discovering demographic and productivity growth was stagnant or falling. Debts have reached 100% of GDP in most economies since 2008. Because central banks have printed unlimited money, the global economy is nearing disaster. My friend says GDP can only be fixed by productivity growth. Crypto technology and the exponential age make the macro expert optimistic about these two asset classes. In Pal's ongoing series On Your Future, he explores global economic concerns and how to win by investing in coins and tech companies. Along with the video, our friend recommends watching the crypto bull market. Like the video, subscribe to the channel, and set post notifications for more. Thanks and enjoy the video.
Is debt, demographics, and deflation. This is the thing that shapes our world. We're driven by demographic forces, and they're baked in the cake. Populations grow, populations shrink. The population of the Western world has been shrinking or has been declining in growth rates for a period of time. There are some countries with different demographics, and I've talked about that before, why India, the Middle East, and other countries are maybe a better investment opportunity than the West in many regards. But you see, the whole thing came about from the debt demographic and deflation understanding of the world. You see, the older the population is and the more debts that they have, the slower the trend rate of GDP growth is. And that's what creates enormous problems. And I'm trying to deal with that and let you understand what that kind of means. You see, and again, without covering all the old ground again, after World War II, we had a record amount of people born in the Western world. Those people, their journey is the story of our economy. The growth go-go years of the 50s and 60s, the inflation of the 70s driven by all of these people coming into the workforce, earning an income and competing for goods and services. Then the 80s and 90s, then the 80s was them financializing. They get to their 30s and they start buying financial assets. That starts moving the price of assets. By the time we get to the 90s, we start to bring other people into this global labor force. So not only have we got a record number of people competing for jobs, but we also then bring the WTO agreement and we start bringing everybody from China to Mexico to Vietnam into the labor force. That means that wages never really went up in real terms. Yet, because people are investing in their 401ks, assets were going up. So that was the start of the great asset unbalance. What happened was, over that period of time, people started taking on more and more debt to fund the difference in the asset price rises versus their wages. And that kind of makes sense. You borrow money to invest in the future. But that got out of control. By the time we got to 2008, the debt side of the equation was literally ridiculous. Every major economy was pretty close or above 100% of GDP in debt at government level. Households were at record high debts. Corporations were at record high debts. And then the world stopped. You see, what happened in 2008 was the value of the collateral of the system started falling. And that was when the equity market starts falling. The real estate market was the real one. That was huge amounts of collateral with massive amounts of borrowing. The collateral falls, the borrowing becomes unsustainable, the whole system imploded. Now, the banking system itself was record leveraged. And what happened was this complete meltdown of the global financial system.
Pal is very optimistic that the industry will grow by 10 times to $1 trillion in the next few years, and then almost straight up to $200 trillion. His only worry is that too many Bitcoin investors will ruin this golden opportunity of a lifetime. Because they're chasing the 100x return and using leverage so much, they lose sight of what's important buying and hanging on to your main bags for as long as possible. Let's get back to the interview.
Back now, I now think that this really was the 1929 moment. But it didn't turn into 1929. And there was a reason for that. Is we had Bernanke at the Fed. And Bernanke had an understanding of what went wrong in 1929. And he had one special trick up his sleeve, which was the use of the balance sheet of the central banks to deflate the value of money itself. And so therefore asset prices optically rose. So that's the denominator effect you've heard me talk so much about. All the central banks agreed pretty much around the same period of time to start printing money, debasing all of fiat currency. Asset prices ripped. If asset prices ripped, well, guess what? The collateral of the system is now saved. So they save the system via this particular mechanism. Now, these are optics. They're not reality. They're optics. And I've spoken before, if you divide any of the assets since 2008 by the Fed balance sheet or global total liquidity or any one of these measures, they've gone nowhere. You see, we've had no real growth. And that led me to start to have an understanding. It was a conversation I had with Jordi Visser, and many of you have now read the Global Macro Investor, the free one I gave out, the annual think piece. And there's an incredibly important article in that, which was 2008, the year the world broke. You see, in 2008, yes, we understand that it broke, but it broke in many more ways. We hit something called peak fiat. And that's Jordi's thesis that I've stolen from him, but it really encapsulates what I'm talking about. That whole fiat currency, debt-driven bubble regime died in 2008. And GDP globally fell. The trend rate of GDP growth ratcheted lower and never rose. But you see, more things happened after 2008 that people aren't really aware of. For example, the dollar has been rising since then. Why? Because the dollar is the global reserve currency. Most of the global debts are in dollars, and there's a shortage of global dollars. And there has been since 2008, and really exacerbated by the time we got to the European financial crisis. So there's a shortage of dollars. There's a shortage of global lenders because of Basel III and the agreements with the banking system. So the dollar rises. Okay, fine. We can deal with that. And that's part of Brent Johnson's dollar milkshake theory. But more importantly, when we look at global equity markets in dollar terms, they haven't gone up. See, here's the MSCI world. It basically hasn't gone up since 2008. When we look at, let's say, a country like Spain in Europe, Spain, I was there over that period of time. It was a terrible situation. Spanish stock market in dollars hasn't gone up. Italy, dollars, hasn't gone up. The Euro stocks in dollars hasn't really gone up. The FTSE in dollars hasn't really gone up. MSCI emerging markets haven't gone up. They've gone nowhere since 2008 in dollar terms. And the same with Shanghai. So the Chinese equity market or the Bloomberg commodity market peaked back then. There's only a few markets that have outperformed this. And those are the ones that I've talked about in the past. Those were technology, crypto, and you could argue India as well because it's different demographic cycle.
There are already steps in place for the cryptocurrency industry to continue to grow and develop over the next few months, years, and decades. But Pal says the clincher is that we are about to enter a massive macro summer during which there will be an explosive increase in the global money supply as central banks scramble to save their different economies from total collapse. It doesn't take a genius to see how all of these things fit together: an explosive increase in the global money supply, new technological platforms emerging and developing at an equally explosive rate, and at the center of it all is the cryptocurrency industry. Cryptocurrencies are indeed the fastest horse in the race, as the industry has shown over and over again. 400 million people in record time, which is more than any other technology ever managed to get. Right now, Bitcoin is the most valuable cryptocurrency and has been for just 15 years. Bitcoin's market value is now much higher than that of companies like Berkshire Hathaway and Meta. Even though the industry has been the target of many bad campaigns, especially in the US, it has been able to bounce back from each one and become stronger. This is reason enough to be very optimistic about the next crypto and macro cycle. What do you think about Raoul Pal's predictions for crypto tech stocks and macro in 2024 and 2025? Please leave your thoughts and predictions for your favorite crypto assets below. Also, don't forget to like this video, subscribe to the channel, and turn on post notifications to get more videos like this. Thanks for watching.